Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
The Nasdaq 100, as you all know, on track for its third straight weekly loss. Thom Forte of Maxim Group covers Apple and Amazon with a buy rating on both. Thom joins us now for more. Thom, the anxiety is overwhelming this week in the tech sector. I don't even know if it's reached Main Street just yet, but on Wall Street, the fear is sky high in two names that you cover, Apple, Amazon. Let's start with Amazon. Lisa mentioned this 8-day run of declines, 18% lower on Amazon. What has made that stock fall out of bed over the last week?
Yeah, so when you think about the weakness in Amazon, I think it's entirely related to the $200 billion CapEx guidance by the company. And if you look historically, without downplaying the significance of a $200 billion CapEx number for Amazon, but Amazon has a track record of ramping investing when necessary to take advantage of opportunities. And I do think that net Amazon can take advantage or capitalize on AI in ways other mega caps can't. They have 1.5 million employees, many at the large fulfillment center level. To the extent that they roll out robotics, add automation, they can have greater efficiency. Now, you've been talking a lot about AI displacing jobs. So I think that if you do the math equation for Amazon, it would be to the extent that automation reduced the headcount at the warehouse level. But at the same time, you have to think about the new jobs that automation would create to the extent that someone has to make the robots, service the robots, things of that nature. So yes, I'm concerned about job loss from artificial intelligence, but I think it's going to be an offset of job loss, but also some job gains.
You know, Thom, John opened the show asking about this conflict that I think really is the conflict. Either this CapEx that all of these big tech companies are spending is not worth it and ultimately is going to backfire on them for becoming asset heavy and not as profit heavy. Or people are just totally mispricing the story, and the disruption is actually, yes, significant on the other side, but is going to benefit these companies in a significant way. Which is it?
Well, okay, for Amazon, again, I'm of the belief that it'll be worthwhile. And I think what's interesting as a student of, having started covering the internet in the late 90s, I remember the build out of dark fiber and things of that nature. So I worry that we're going to have this, ghost data centers in the future and things of that nature. But the good news, I think, for Amazon and for other mega cap tech companies that are ramping their CapEx is that presumably if they don't see the returns, they can scale back the numbers. It isn't that Amazon spending $200 billion in one day. So if you look at Amazon again, they've scaled back some of their leasing commitments when they determined that they didn't need as much fulfillment center square footage because there wasn't the demand. So I do think that as it pertains to Amazon, if they're not seeing the positive performance that they're expecting, greater efficiency at the warehouse level, greater efficiency also at the software engineering level, better sales from e-commerce, things of that nature, it's not like they can't stop the spending. They can turn it off.
Thom, is the tech really that good? Is the AI really that good to disrupt all of these potential industries? Is this sort of heat-seeking missile that Joe Amato of Neuberger Berman was talking about, is it truly that in terms of its efficacy?
So you're asking me, so today, we'll call it, day before Valentine's Day, 2026, is the technology that good? To the extent that I have, spent a lot of time with Alexa and Siri as an example of, AI and things of that nature, the answer is absolutely not. The question is, in the future, will it be that good? And it remains to be seen. But I would say, Lisa, today I'm convinced the tech is not that good, but that doesn't mean directionally we're not heading to a point where it'll be much better than it is today. And I think that's, very much possible.
Thom, I'm not going to ask you if you're spending Valentine's with Alexa and Siri. I'm not going to ask that question.
You just did.
But you basically asked it yourself.
taking my wife to dinner. But thanks, Jonathan, for worrying about me.
Otherwise, you could have joined us. I was concerned. So I'm going to follow up on Apple. I want to talk about Apple very quickly. 5% move. Is this the threat of a margin squeeze from memory, or is it about falling behind with AI? What's the move about?
It has to be the margin squeeze on memory. So, Jonathan, I was thinking back to last year being on your show and wondering if we had a super cycle for AI for Apple. 20% growth in iPhones in the December quarter would make us think yes, but they're nowhere with AI. So I think that the 5% move is concern on memory. Apple historically does very well when they have a product selling as well as the iPhone 17 and improving the margin over time. They could take price, managing supply chain is Tim Cook's forte. So I'm not worried about memory maybe as much as the market is right now.
Stay with us. More Bloomberg surveillance coming up after this.
Tiffany of PIMCO joins us now to talk about the data. Tiffany, welcome to the program. How much weight can we put on this week's data? Hotter than expected payrolls, softer than expected CPI.
Well, I think this morning's inflation print, even though it was in line with the Bloomberg consensus expectations, was actually pretty encouraging under the surface. I think there's two things that we would highlight in that regard. One is just that shelter inflation, which had been stubbornly, just persistent since the pandemic, it's finally really decelerating. And we saw that in today's report. Rental dynamics for new tenant rents actually suggest that you're seeing a pretty stagnant rental market. And that will ultimately feed into OER with a lag. So that's good news for the Fed. I think the other good news in this report, is that the tariff-related effects are largely fading. So we probably did get a little bit of a bounce back in core goods prices, retail goods prices from the discounting that happened over the holiday season. But ultimately, it looks like tariff effects have they're behind us at this point. They were passed through to the extent that companies were going to do it. So as that fades, you should have a Federal Reserve that feels more comfortable, cutting interest rates. It does look like they are a little bit restrictive relative to the median long-term estimate of the long-run neutral interest rate. So getting a couple of more cuts in this year seems very reasonable to us.
Tiffany, not all rate cuts are created equally. Do you see then a Federal Reserve that's cutting interest rates because inflation gives them the space, or because the labour market gives them a reason?
So I think so. For us, the outlook for the labor market is pretty stable here. Ultimately, we think growth is going to be okay this year. We're looking for 2%. That should support the labor market, but nevertheless, you do have this AI-related adjustment that's happening, under the surface. So those factors are sort of offsetting. We're looking for the unemployment rate to kind of stay where it is, and then outside of that, we're looking for inflation to moderate back to target this year. So that, in our view, would be consistent with the Fed that's easing somewhat. Of course, if the unemployment rate were to rise much more, then that would warrant more easing from the Fed.
Tiffany, do you think that this actually opens the door to 3 rate cuts this year, as the market seems to be implying right now? We'll definitely have to see. It's certainly possible that they could get in 3. Again, I think as kind of a rough estimate, we're looking at the midpoint of the long run neutral estimate, which is right around 3%. They're at 3.5 now, so that implies 2 more cuts. I think getting another one in would be the result of more disinflationary pressure, potentially below target inflation, or the unemployment rate moving up. I understand the idea of celebrating disinflation. We're still at 2.4% year over year for CPI, and people are saying this is winning. How strong is the disinflationary force coming from the housing sector that gives you confidence that we're actually going to get down to 2%, even with Fed rate cuts, given that we've been above 2% for 5 years?
Yeah, the housing sector has certainly been one of the reasons why, that we've had stickier inflation. So the housing OER and rental inflation have been incredibly sticky. That's in part because of it just takes them longer to adjust. So they didn't accelerate as much as home prices did during the pandemic, but now they're decelerating at a slower pace. That's finally over. It looks like that catch catch-up has happened in the rental market, and you're now seeing more stagnant rental trends. So that is important. But again, the other thing is that the thing that's held up overall inflation over the last year is some pass-through of the additional costs that companies have to pay as a result of tariffs. But that's a one-time price level adjustment. And when we look at core goods price behavior, it looks like that adjustment's largely happened. So now that it's happened, you should see core goods, price inflation also starting to decelerate. So again, all that is good news for the Fed.
Tiffany, just one final comment, if we can, on the committee that Kevin Walsh will ultimately at some point this year be taking over. How contentious will things be? How divided is that committee currently?
Well, I mean, I think you want to look at where everybody is, where everybody's sort of writing down where they think the long run neutral interest rate is, because that's going to be the debate this year, we think. And of course the AI, and the technology related to fusion will have implications for that R-star debate. But there's a good majority of the committee that still thinks that the current policy rate is above their estimate of R-star, which means policy is slightly restrictive. And if you have employment that is consistent with maximum levels and you have inflation that's running at target, you should be at neutral policy. And so again, the real debate this year on the Fed is where neutral policy is going to be. And again, we're kind of looking at the midpoint of their estimated range of 3%.
Stay with us. More Bloomberg surveillance coming up after this. Global leaders gathering at the Munich Security Conference. The U.S. Secretary of State Marco Rubio leading a delegation as the Trump administration pushes transatlantic ties potentially to their limits. The Republican Senator Thom Tillis is on the ground in Munich, and he joins us now for more. Senator, welcome back to the program. Forgive me for doing this live in the moment, but the news just crossed. This is on Alibaba, reporting from Reuters that the Trump administration is expected to add Alibaba to a list of firms that allegedly help China's military. This according to reports just moments ago. Senator, clearly the U.S. administration, and Congress for that matter, is looking to put a bit of a squeeze on China. Landing in Europe, in Munich, Germany, do you believe that you have the Europeans on side in this effort?
I think we do, but let's go back to Alibaba. And honestly, any business that's domiciled in China, does anybody really believe that there's separation between the CCCP and the state-owned enterprises and other supposedly independent businesses? I think the president is on the right track to make sure that we're starting to hold China accountable. We need a good relationship with them, but it needs to be one that's founded on trust. And quite honestly, there are moves in China that I don't trust.
So, Senator, with that in mind, should U.S.-based investors be able to have access to investing in these companies?
Well, look, I've got a real problem with. We had a banking committee meeting yesterday with Atkins before from the SEC, and I've got a real problem with the U.S. getting into a trend of buying into some of our companies. I feel like we should let the free market really drive innovation, and also back to the segment before. I watched your prior segment. We've also got to unleash AI. We can't be afraid of it. We have to embrace it. We have to leverage it, and we have to be the leader in innovating in it.
Well, Senator, let's talk about that. Creative destruction is a feature of the U.S. economy, and American dynamism is something Lisa was talking about earlier on this morning. Senator, I feel like there's an aversion to that these days and a fear associated with some of the headlines we've all seen over the past week, the prospect of white-collar jobs being wiped out. How do we prepare for a moment like that and ensure that what globalization did to manufacturing doesn't happen to services with AI?
Well, we have to be ever watchful, but the bell has been rung. We can either decide to be the innovation leader and work with our partners and allies, the nations that we have military alliances with, to make sure that the Western world is still in the front of it. But I'm reminded of books that I read about the Industrial Revolution, and any time that we've had a major leap in technology, we can't pretend like it didn't happen. We have to figure out how to master it and be need the best practice in executing it and dealing with all the potential negative consequences and job displacement. I think the jury's still out on what the net job displacement is going to be. Does it mean that we've got to put more money in education and retooling expertise around the needs of the AI future? Probably, almost certainly, but we should resist it. We should make sure that we get rid of the patchwork of laws that are being implemented at the state level that are impediments to our own indigenous innovation in AI, come up with rules of the road at a federal level, and just unleash the power of the U.S. innovation economy to lead the world and get it right.
Senator, do you feel like internationally there's the same skepticism? You're in Europe. It's known for regulating. They're experts in it. And it seems like a growing number of people feel like that is hampering some of the progress. I mean, is there the same kind of enthusiasm? What's the mood like around some of the AI story that's causing a lot of volatility, certainly here in the United States?
For years, I've been trying to remind everyone of how critical we were of the GDPR, data privacy, data breach policies that the EU implemented. They made mistakes. They corrected some of them. But then states started gold-plating some of those policies, California and other ones, that are, again, impediments to our tech sector. What we need are national rules. This is clearly interstate commerce. We need to preempt these laws, make them better. If we find a best practice, be instructed by that at some state level. But we need to set that platform right, or the malign uses of AI are going to outpace our ability to stay up with them. That's why I think it's so important. I was the only one, actually. 99 members voted against it. There was an amendment last year to try and preempt the AI laws at the state level, come up with a national standard. I think that we need to do that very quickly, and we should throw data privacy, data breach in there so that we get it right, and maybe we have a gold-plated standard that Europe can be instructed by.
In the meantime, as people are concerned about this labor market transition and the pain that could come alongside it, it's one reason why there's been so much focus on the Federal Reserve. It's one reason why people are saying it might behoove the Fed to cut rates more aggressively in order to ease the pain for a number of individuals that otherwise might be losing their job. I mean, how much are you feeling satisfied in the process that you could get a hearing for the nominee, Kevin Warsh, in the not-so-distant future? Do you think that that's feasible?
Well, we could have a hearing all we want, but until the investigation is done, I still believe that the initial inquiry and the investigation was a flex to try and get the current chair to step aside. Chair Powell has a term as chair that expires in May. He also has a term that could extend for 2 more years. I have no intention of allowing any Fed board nominee to move forward out of committee and to be confirmed until this matter is settled. Look, this is foundational to Fed independence, and I, for one, am going to stand on the side of certainty, and Fed independence is what delivers certainty in our markets.
So, Senator, it's intriguing because we heard from the Treasury Secretary earlier on this morning speaking to the American press, and he said the following, that I spoke with Republican senators early this week, and I think we have agreement to go ahead with the Warsh hearing. Do you have an understanding of where he's getting that impression from?
Well, you know, I've said that if they shouldn't confuse or conflate two issues. The suggestion that we should have an oversight hearing to see how well this building project with the Fed has gone is fine with me. In fact, I think we should have that kind of oversight for the East Wing construction, the upfit of the Air Force One that's kind of a mini Air Force One because it can't fly out of U.S. borders. All of that is just good governance oversight. None of that has anything to do with an investigation that I believe was dead on arrival. We are talking about 2 minutes of testimony that 7 members of the Banking Committee, Republican members, including the chair, have all said did not constitute a crime. We've got a prosecutor who's not listening to the eyewitnesses and continuing. That's not productive, and I'm not going to allow it. Maybe they can convince a Democrat to vote with them, but as long as I'm the deciding vote, we can have Mr. Warsh, who I would love to be the next Fed chair. But I'm not going to confirm the next Fed chair until I can be absolutely certain that these sorts of flexes do not always have members of the Federal Reserve Board or the chair looking over their shoulder, wondering when they get the call from some U.S. attorney with a dream.
Senator, have you had the call from Treasury or from the White House about this? When was the last time you had the conversation on the issue?
Well, I've had a conversation with the American people in C-SPAN yesterday on the floor, and I don't think I was mincing words. I'm not really known for that, but if I need to make it very clear, this is about an end or a resolution. I'll give the prosecutor the benefit of the doubt. Provide me with evidence beyond the 2 minutes of testimony in the committee that 7 Republican members said it was not criminal, it was not misleading, and that there was no criminal intent. It's like an indictment looking for a crime, and to me it's at the edge of absurdity that I can't accept. The only thing I know that I can do is exercise my right as an individual senator to hold up future nominations until this investigation's done. But to the assistant U.S. attorney, bring me evidence beyond the 2 minutes has been rejected out of hand by the majority of Republican members on the committee, or prove to me that there's been an instance where a referral. What's really odd about this, and I spoke about this on the Senate floor yesterday, this is the first time that I can find where a prosecutor moves forward with an investigation without a referral from the chair or a member of the committee. Maybe somebody can prove me wrong, but if that prosecutor has compelling information, either the way they read that 2 minutes or something else that no one's aware of, let me see it.
Senator, before you go, time for one final question. You're in Munich. Let's finish where we started. Chancellor Merz just spoke moments ago and said the transatlantic partnership is no longer self-evident. Senator, how well received was your delegation in Munich?
Well, we're going to have, I think we're going to have a lively discussion here. I had someone ask me about J.D. Vance's, Vice President Vance's speech last year. I said that I wouldn't have given that speech, but I would not have missed the opportunity to let my family of nations in NATO know that one of the reasons we're here is because of the $2 trillion deficit over 20 years. Jonathan, can you imagine how much more ready we could be if all the demand signals that would have come from $2 trillion in weapons and our mutual defense had actually been purchased by the countries of NATO who have failed to even meet their minimum requirement? So I think there's frustration there that we need to get past. But I am speaking, I believe, for the majority of Congress who knows that the NATO alliance is the most profound and impactful alliance in the history of mankind, and we stand behind it, and we will as we go through this discussion to get things back to normal.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.